Hey there, it's Ian, and it's been a while since we did a transition snippet, but I wanted to share some thoughts today on management and different stages of management. And hey, so for one reason I haven't done a snippet for a while is this little girl. This is Marley, our new puppy. She's just turned 4 months old a couple days ago. She's keeping us very busy. And she's like an entrepreneurial startup. I was thinking about this the other day. She chases everything: squirrels, falling leaves, other dogs, our cat, anything that is thrown on the floor. And yet she changes her attention very quickly. So you can throw a ball, she'll go and she'll get it, she'll bring it back, throw the ball again, she'll run after it, it stops, she comes back, forgets the ball. And that's very much like entrepreneurs in the first, when they're starting up a business, trying all sorts of different things, chasing rabbits, chasing squirrels, and finding out what really works. And so, that's great. We need more of that. We need more people to be coming up with entrepreneurial ideas and chasing squirrels and coming up with new solutions for problems. But as you get more mature, your business gets more mature, you grow, it gets harder to find good people to manage the business. And right now, if you look at the gap between available employees and the needs, it's only going to get worse. And COVID has taught us one thing: when we shut down immigration, those lower end or entry level jobs can't get filled. And I think even our local Starbucks can't stay open for the normal hours because they just can't find staff. And I think that's going to be a problem for a long time to come. But anyway, I digress. What I wanted to talk to you about today is to think about 3 different styles of businesses and which one of these you and your company fit into. And the first style I think about is what I would call a lifestyle business. And most lifestyle businesses, it seems to me, have the name of the owner on the door, or it's Ian Smith and Associates, it's Betty's florist, it's John Smith and Associates engineering firm. These are businesses that were started by people that wanted to do something that they really enjoyed, and they wanted to set up a business to do just that. And they're happy doing that. They may not have plans to rule the world or take over the market for whatever service they are, but they're really happy in their particular niche. The next style, which we tended to work with more often, is the entrepreneurial venture. So you've now matured, you've got a team, you're building products, building service, selling services, selling whatever you're doing, you're making money, you're hiring people, you're having to fire some people, you're looking at opportunities in your marketplace and other marketplaces, etc. But in this case, the management team are very functional. You've got a finance person, and they think about that finance role. You've got a marketing person. You've got maybe an operations person, production person. But they don't think outside of their functional area. So you as the owner are having to be the glue that connects all of those different areas of the operation. And so you're, in a sense, you're deep in the operation. You hear this all the time. You're working in the operation. Because there's nobody else that can pull all of those pieces together, and nobody else is thinking about the interconnectivity of those different departments, except for you as the entrepreneur. And if you're fortunate enough to get to that next stage in corporate development, you become more of a corporate enterprise. And I know that seems like the antithesis of what an entrepreneurial venture is, but when you can take an entrepreneurial business and transition it into a corporate enterprise, it allows you to work above the business, think strategically, think long-term, plan capital expenditures and budgets, maybe look at acquisitions, think about other aspects of the business. The only way you can do that, though, is to hire strategically minded management. And you think about, say, a corporate controller or a finance executive that you've hired in that entrepreneurial stage. Well, now you need a CFO or chief financial officer that's going to actually think about the impact of financial decisions on production, on services, on hiring, on capital budgets. So they're interacting with those other departments. They're working with the HR folks. They're working with production and engineering, whatever type of company you might have. And that allows you not to think about that interconnectivity so that you can then work on other areas of the business. Maybe, going back to what you did really well when you started your entrepreneurial business, which is creating new products, creating new ideas, coming in, thinking about new market opportunities, etc. And I think entrepreneurs that can transition into that phase end up, loving their business as much as they did at the start, as opposed to be feeling overwhelmed that they're so buried in their business. So how do you do that? How do you transition? Well, it takes time, and it's really a step-by-step process. Personally, I believe the CFO is the number one position that you need to have, because it impacts financial decisions, impact all aspects of the operation. And having strong budgets and financial controls and other aspects of the financial backbone of your business really strengthens all the other component parts, so that you can build those other strategic management pieces on top of that over time. You can train people in those positions, but it's very difficult if you don't have experience at a strategic management level in production, in engineering, in finance. So my view is that it's better to bring in that expertise, pay the extra money that it's going to cost, because the return on that investment in those people, it will be so significant. Now, the other challenge business owners have when they transition from that entrepreneurial stage to the corporate stages, the demands are much higher. These executives have worked through their careers in maybe bigger companies, more difficult environments. They're bringing all this experience with them, and they demand more. They demand higher salaries. They demand better benefits. And quite often, they want incentive plans. And so I over the last month or so, I've had a variety of discussions with business owners about what is the right type of incentive plan for my team? How do I attract people of that caliber? And what do I need to do? And my answer, quite honestly, is it depends. It depends on the role. It depends on the size of your business and the budget and the impact, the return on investment that each of those positions is going to have in your organization. So it does depend. It's not a great answer, but when you think more deeply about it, a couple of things come to mind. That making the right hiring decision is critically important. Spend a lot more time than you have in the past in hiring the right person for each of those roles. And just because they have tremendous experience in that particular area doesn't mean they're going to be a right fit for you. And I see this a lot where entrepreneurial businesses that are transitioning into that corporate world hire somebody from a much larger corporation. And those executives have a different expectation of the support they're going to get for their role. So you got to be kind of careful there. The other thing is, I would say, don't give up equity, like real equity, shares in your company too easily. And that goes for early stage all the way through to a corporate enterprise. There's other ways that you can incentivize management without giving up equity. Next, I would say, don't expect that any kind of incentive plan is going to motivate your employees. That's the wrong approach. You should be hiring highly motivated people, and the incentive plan should do exactly what it says. It should incentivize particular actions or specific actions that are going to generate the results that you want. You got to be really careful about this, because quite often people put together incentive plans that seem perfectly thought out at the outset. But what happens is that it's human nature, I guess, that people will game the system. So if your incentive is for your salespeople to maximize gross margins, they may only focus on one or two products that have the greatest gross margin and forget all the other products that actually sell a basket of products. And it may get you off track of where you want to be in terms of developing new products that are going to market that may have lower margins but greater potential in the long term. So thinking about that is very important. Making the incentive plan fair to everyone is really important, but it doesn't have to be equitable. So what I mean by that is treat everybody fairly, and that's sort of a given, I suppose, for most people. But it doesn't have to be the same plan for everybody. So the salespeople might have a plan, the finance people might have a plan, the marketing people or the production people, engineering, whatnot, have different plans to suit their role, their experience, their department. So that's something that I think is really, really important. Tie as much of what you can to actual performance, cash flow, for example, or EBITDA, as we talk about in the finance world. Maybe on the production side, you want to incentivize on gross margins from your facility. Maybe it's utilization of your employees by hours and things like that. How many hours does it take to produce a certain product, a certain software, whatnot? Make sure that the plans are well documented. I think it's unfortunate, but the times have changed that a handshake on these sorts of things just doesn't work. The businesses evolve, people's memories maybe get a bit fuzzy, and these are complex issues. So use experts, HR experts, legal experts that have experience in incentive plans when you're setting them up, because I think it will save you so much time and grief down the road when things change. Now, I mentioned about equity, not giving up equity too soon, but as you progress into more of a corporate type of environment, think about phantom equity. And you may hear this, it comes under various names, but phantom equity or shadow equity, as some people call it, is basically having the benefit of ownership without owning the shares. So your income would be based on the performance of the company as if you were a shareholder. So if the shareholders are getting dividends, you would have a payment, an incentive plan fee, which would be more like earned income as opposed to dividend income. But you're incentivized as if you're an owner. And that is true right through to a transition event. So if that particular person is in the company at through this stage, and you sell the business and they have 3% of the company as phantom equity, they would end up with 3% of the proceeds at the time of the sale of the company. It's a really powerful incentive for the right people. And yet, if that person quits, moves on, passes away, sadly, that equity doesn't go with them. Whereas if you have shares, or you've given away shares, or you have an ESOP, which is an employee share plan, those employees have those shares, and you can't really get them back without buying them back. So I really like phantom equity for the right type of employee at the right level. I think that it is a huge, very powerful incentive, not only during the time that they're operating the business, but as you get closer to a transition event. It does help incentivize them, even if they're going to roll equity forward or continue as a shareholder under maybe a private equity buyer scenario. So lots of good things about it, but it needs to be well thought out, well documented, and it needs to fit the person that you're hiring. So I guess the message is hire the right people, put in the right plan, think things through very carefully before you finalize the plan. Treat everybody fairly, but not equitably. I think that's a good lesson to remember as well. And think about that transition from an entrepreneurial venture to a corporate enterprise, where you can take yourself from being the glue that holds all these divisions together to being the chairman type role, where you can think long term, think about the future of the business in much clearer terms than you could if you're deep in the weeds. So that was it for today. It's a bit of a longer transition snippet than I normally post, but I thought it was something that's come up a lot recently with people that are business owners that are having challenges hiring good quality staff these days because the market is so tough. So I hope this is helpful to you. There will be more details on this in my course that's coming up, and I look forward to seeing you at that as well. So take care, everybody. Have a great day. Bye.